So how should you position your portfolio given these latest moves in yields? Let's bring in David Spica. Mr. Spica, you've been vacated, Mr. Spica, the president of Guidestone Capital Management, and Jerry Castellini, chief investment officer at Castle Ark Management. David, since you're in the house and we haven't seen you here in 3 or 4 years, welcome first. Welcome back.
Happy to be here, Tom.
Glad to have you here. What do you think these higher yields are going to mean ultimately for equities and equity values? And what kinds of equities do those moves infer?
Sure. So 2 things I would say is that higher yields tend to be negative broadly for equities because they reduce the present value of cash flows. So the current value of the equities has to fall. The other thing to keep in mind is higher yields are more detrimental to longer duration equities, like the tech companies whose cash flows are way out in the future. So that's why the tech companies have come down the most in this higher yield environment. All that said, the yield volatility is what concerns us the most. It's not so much that yields are up, it's that the volatility is crazy. Look what's happening in the 10-year today. So for bond managers saying, well, we want to take out more duration, we want to go longer duration because the 10-year is approaching 5%, well, you're playing with fire there because there's still so much volatility, and a lot of this is a function of what the Fed is claiming to do.
So from a portfolio standpoint, what does this cause you to do, if anything? Does it cause you to invest in different kinds of equities, or does it cause you to invest in a reduced percentage of equities in your portfolio, or both?
Well, we're not trying to time the market, but at this point in time, given the thought that there likely will be some sort of economic downturn, we want to own more defensive companies, and we want to own companies that have visible earnings growth. When growth becomes scarce, investors pay up for growth. That's when you want to own growth stocks. Now, yields will eventually fall if we do have a downturn, but we also like short-term and short-duration investment grade credit as well, because where the yields are today, we haven't seen since 2007. It's very attractive.
And you hope there's no default risk when you're talking about, you know, the bluest of the blue chips.
Correct.
Jerry, one of the sort of confounding things is that, to quote Josh Brown, the safest parts of the market have been some of the underperforming ones lately. So pain and utilities is well known, obviously. A stat from Bespoke says the 100 highest dividend yielders in the S&P are down 11% this year. So, you know, people might feel like, okay, well, I want to be defensive, I want to be safe, but what does that look like exactly?
Yeah, so those traditional areas that you were describing, like consumer non-durables and utilities, their valuation and or their cash generation abilities aren't what they used to be. Utilities, as a classic example, they borrow money. They don't throw off free cash. They're building the future of the electrified economy. So when you see the yield curve behave the way it has, there's no question that that entire approach is under threat, and it would be anything but defensive. If I could move you, though, for a second, as much as people want to take on the Magnificent Seven and these very large companies, they're the ones, as your previous segment just described, they have all the cash on the balance sheets. They're going to continue to generate cash. And when you look at the, quote, defensive trade, it's migrated towards those kind of names and away from these are their slower growth or balance sheet challenged ones like we just described.
So where would you put money, Jerry, right now? Give me some names.
Yeah, right now, I mean, you look at the cash coming out of a Meta, Microsoft, both of them are down significantly in value from where they were, let's say, 2 years ago. I mean, Microsoft at 25, Meta at 17 times earnings. That's more than attractive in a 5% long bond environment. They just throw off so much cash, and their runway is so long in the businesses they have. I don't see how that's not your ultimate defensive play. But if you want to go beyond that, why not look at the energy names?
That was not 220. Go ahead, Jerry, go ahead.
Yeah, I'm just saying, look at the energy names that, you know, we marked down the price of oil $8 here in 48 hours over fear of recession, and yet no one's fixed the world oil problem. The fact that we haven't put any money into the ground for so long, that Schlumberger and Exxon have a wind behind their back, and they already started at very attractive low valuations. So you take those two extremes, something that's trading at 10 times has a 5% yield and a 5-year runway, and something that's trading at 20 times with a similar set of characteristics. I think you cover both risk profiles in the market itself, and I think that's a great way to balance the portfolio.
All right. We're told we have to depart right now. Thank you very much. David, good to be with you. Thank you for coming.
Thank you.
Jerry Castellini, thank you as well.